This is when the Fed will pivot, and it's not what you think. Now, the Federal Reserve controls the market, and they've decided to fight inflation by raising rates and tightening, which has been causing the markets to crash. And many people have been asking me, when do I think the Fed will pivot and stop raising rates and go back into easing? So the markets can go back into the melt-up stage and make new highs. So in this video, I'm going to break down how the Fed controls the markets, what's happening in the markets with housing and stocks, what the analysts are saying must happen before the Fed pivots, and then I'm going to show you what I think they're really looking at. And hint, it's not the stock market. And I'm going to show you what the real pivot is that's coming and what you should be doing about it. So let's go. All right, welcome back. If you're new to the channel, my name is Mark Moss, and I make these videos to change the way you think about money because almost everything you see here and have learned is wrong. I'm gonna help you try to cut through that. Now, as we're talking about today, will the Fed pivot, or I should say, when will they pivot? And I think a lot of people are looking at the wrong data points. So I want to show you what those data points are. I'm also going to talk about how we can protect ourselves from whatever may happen, classifications of where you should be putting your money, things like that. Now, if you want to know more, like exactly what names am I buying, I'm going to do like about an hour-long presentation next week. I'm going to have question and answer for you so we can ask questions. I'm going to show you the exact names and stuff that I'm buying. I want to go deep. I can't do it here on YouTube, but if you'd like to join us for free, there's a link down below. Come join me. We'll dig in deep into this whole macro environment, what I see happening over the next couple months, what I'm doing about it specifically, and like I said, Q&A. So join me. It's free. There's a link down below. All right, now jumping right into the lesson that we have today. Starting at the top, forgive me if you're too advanced. I'm going to start at the top real quickly, but printing money. So it all starts with printing money, booms and busts, booms and busts, booms and busts. We're talking about the Fed having control over the market, and they do this by controlling the money supply. You create more money, you have booms. You subtract money, you have contractions, you have busts. That's how it works. So printing money. The first thing is we have this image of Jerome Powell over here with the money printer, the money bazooka. And we talk about money printing. That's not exactly how it's done. They don't exactly print money. Most money in circulation is not paper anymore. It's all digital. What they really do, and this is just a key piece to understand if you want to understand how these booms and busts works, is what they really do is the Federal Reserve creates money, prints it. They create money by purchasing securities on the open market and then adding the corresponding funds to the bank reserves of commercial banks. So the fiat money system that we're in is a debt-based money system. All money is based off of debt. And so money is created through debt. So it starts with the Fed. The way they create money is by purchasing the securities, and they put those onto the banks as reserves. So they give the bank reserves. Then, when the banks have reserves, they increase the money supply in circulation by making loans to consumers and businesses. So when you go get a loan from the bank, whether that be for a car, a boat, a house, student loans, whatever, you name it. When you get a loan, that money is created into existence. So the more loans being created, the more people borrowing, the more money is being created. When people stop taking loans or are not able to get loans, then money goes back down. Pretty easy to understand. And it starts with the Fed because the Fed is what gives the bank the reserves that allows them to go create more loans. So they set the reserve requirements, how much they have to keep on reserve for the amount of loans they make. The other thing that they do is the Fed uses the federal funds rate, the interest rate. So we're going to talk about today, the rates going up. The Fed's funds rate to affect interest rates and adjust the money supply. How does it adjust the money supply? Well, when rates go down and things get cheaper, people borrow a lot more. When rates go up, people don't borrow as much, right? So through the rates, they can control how much money is being created and destroyed. We can take a look at this in a chart right here, and we can see the Fed funds rate. So this is where the Fed sets the rate. Now, I went back here to 2006, and the reason why is I wanted to show you for the last couple booms and busts how this works. So the rates are going up, 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 meaning the cost of borrowing is going up, which means people borrow less. And then what happens? These gray areas always represent a crash in the economy. So they went up, 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 and then the market crashes. So then they bring rates all the way down to try to stimulate the market. Hey, everyone, go borrow more money. We need to get the market moving again. So as we go into this gray area, this crash, they're trying to stimulate the market, and they held it at almost zero for all this time, just trying to get people to borrow, to try to get that money moving again. And then finally, Jerome Powell took power of the Fed, and he thought, now let's be aggressive. Let's start raising the rates. They raised. And then what happened? We have another crash, and now they lower it all the way back down again. And here we can see they've basically held it at zero. And as you can see in the chart right here, in the little corner, they're just starting to raise rates again. What do you think is going to happen? I could probably show this to an elementary kid, and they could probably tell us what comes next. But let's dig into that a little bit further. All right, now, so as we talked about, the rate hikes, as they start increasing rates, people borrow less, and it destroys debt. What does that mean? Well, when interest rates are low, we hang on to the debt. People ask me all the time, Mark, should I pay off my debt first, or should I invest? Well, the answer that I typically would give is, if the interest rate that you're paying is less than the return you can make investing, you would keep the debt. So for example, you bought a house at 3% interest, well, and you hope you can go make 10% in the market, keep the 3% debt. If you're paying credit card debt, that's 15%, 18%, you're probably not gonna be able to make that in the market, so you should pay that debt off first. And so as rates go up, people decide to pay the debt off instead of spend and borrow more. When they pay the debt off, it shrinks the money supply, right? Money supply increases by taking on debt, it shrinks by paying it off. Now we can see, when we go back through history, every time we have a rate hike, we have a market crash. Rate hike, crash, 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 rate hike, crash. You get the picture. Why? So they inflate the money supply by creating more debt, and then when they decide that the economy is running too hot, there's too much inflation, they suck the money back out. And so they create the boom, they create the bust, over and over and over. They do this to us, not us on our own. So where are we at now? Like I said, I showed you in this chart right here, you can see that they're just starting to raise rates again. Of course, they've been talking about this. You already know this by now. The market experts, we'll call them that, the analysts are all predicting rate hike expectations. We can see that there's about a 50% belief that they'll continue raising rates through Q3 of this year, but then they think that the likelihood of them continuing to raise rates goes down. Well, at the end of this video, I'm going to show you the exact thing that I believe is going to be the trigger to cause them to pivot off the rates. So make sure to stay tuned for that. But this is the Fed dot plot. So basically they've kind of put out these projections, and they expect to raise rates in this area right here. And this is kind of what we're expecting, maybe getting up to about 2%, when right now we're sitting right about there. So what do you think is going to continue to happen as that continues to go up? If you've guessed it, and if those charts helped you, you've got it right. The market should continue going down. All right, now we're already seeing massive effects of this. It's starting to happen really, really quick. And that's what happens as these bubbles get bigger and bigger and bigger, the effects are exaggerated. And so these little moves all start to create big, big moves. And I think why the Fed thinks they can control this, I think it's going to be out of their control. But let's wait till the end and we'll take a look at that. So the effects in housing, we can see that the amount of applications for new mortgages is going down. So these are what we call leading indicators, all right? We're looking for trouble before it happens. So if people are taking less applications to buy homes, that means less homes are being sold, obviously, right? So we can see here that the rate of new applications is going down at a pretty rapid rate. Now, while this chart looks bad, analysts can basically show you whatever they want. While this chart looks bad, if we zoom out, it's not all that bad. It's not like the world's crashing all around us. So if we look at it on a zoomed out chart here, what we can see is that we're still actually pretty high. It's just barely starting to roll over, but historically speaking, we're at a pretty good level. So is it slowing? Yes. Is it crashing? Is the world about to implode? No. So just keep that in mind. Now, what's the next thing? What are other leading indicators? Well, building permits. So if we're going to get new homes on the market, before they can build the home, they have to get the permits, right? So we can see that the building permits have slowed down. So the alarming headline is building permits are down. They are. They're down from very extreme levels, and they're down just a little bit. But historically speaking, they're still very high. Now, this is just 2021. If we go back further in time, maybe I don't have that chart. I thought I had it up here. Oh yeah, here's building permits. If we go back further in time, what we can see is, yes, building permits are going down, but again, historically speaking, all the way back here to 2017, they're still really, really high. So are they slowing? Definitely. Is the whole world melting down? Not quite yet. We can also see that new home sales are dropping. So we can see here, this is the big number that came out just this week. Analysts were expecting about a 1.5% decrease, and we got about a 16%. So it's alarming because the analysts were so far off. It was way worse than what they had expected. So we can see right here about a 16% decrease in home sales. But again, if we go back out, it's, not that bad. Here's 2013, which was kind of the bottom of that 2008 great financial crash. What we can also see if we look at it in a different chart is we are all the way back to where we were right around the March 2020 crash, which of course wasn't a good time, but as you can see, it was still somewhat high. So yes, it's slowing down. Is it the end of the world? Not necessarily. Now, another piece that you need to keep in mind when we're looking at this data specifically is that while home applications are down a little bit, and while permits are down a little bit, while home sales are down a little bit, the price of homes is still going up. So the price of homes isn't coming down yet. But what's important to look at about this is what we can see here is the average annual price versus the median price, right? And what we can see is that there's a very big divergence right here. So what does this tell us? This tells us that the lower price homes are being adversely affected while the higher dollar homes are still continuing to soar. So when you're looking at the real estate market, I like to say over and over, there is no such thing as the real estate market. There's thousands of sub real estate markets broken down by location, size, type, value, etc. And so what we can see here is that high dollar homes are still moving up at a much faster pace, especially compared to lower value homes. Now, like I said, the money supply, the booms and busts are controlled by the money supply, which is controlled by both the Fed giving reserves to the banks and interest rates. Again, back to interest rates, we can see that mortgage interest rates are going up. Now this one's moved up quite a bit. We can see here, just at the beginning of this year right here, we were sitting at about 3%, and now we are up about 65% just in the last couple of months. So with the increase of home prices and the increase in the interest rate, you could be paying 60, 70, 80% more on your monthly payments just in the last couple of months. Now, what happens when the price of the monthly payments go up by that much? Well, one of two things happens. One, either people don't buy, or two, maybe they buy, they just buy less house, which is maybe why we're seeing that bottom part of the market being affected. Now, I do want to bring this up real quickly because a lot of people want to know what to expect from the real estate market, especially if they have investments, real estate investments. So one thing that we can keep in mind, we can look back from 2008 during the great financial crash when the real estate market crashed, the rents didn't crash. As a matter of fact, in a lot of areas, the rents actually went up. Why? Well, all these people lost their homes and were turned into renters. Everything always boils down to supply and demand. If you have more demand for rentals than you have rentals available, the price of rents go up. And so what we can see is that as the real estate market is softening, as it's slowing down, we can see rents are not slowing down at all. As a matter of fact, they are continuing to crank. We can see here Chandler, Arizona is up almost 70% year over year. The price of rents almost doubled. We can see Miami, Florida, 60%, Portland, Oregon, 51%, Austin, Texas, 50%, Tacoma, Washington, 46%, Salt Lake, Utah, 46%, New Jersey, Jersey City, 41%. Now, there's no such thing as the real estate market. The average nationally is about 25%. Some are up almost 70%, but some are also down. So we can see Shreveport, Louisiana, down 18%. Wichita, Kansas, down 18%. Toledo, Ohio, down 16.5%. Indianapolis, Indiana, down 12%. So there's no such thing as the market. So you want to look at things much more pocketed, but we can see how that's working out. All right, now back to the Fed and when will they finally pivot? So a lot of analysts think that when the stock market reaches some new low level, that the Fed will finally pivot. The Fed will not allow the markets to drop, will they? Let's take a look at that. So what we can see is that the markets are testing what we've been talking about for a couple years here on this channel, is the Fed put. Meaning, we think that the Fed is always going to keep the markets up, and so as long as the Fed's willing to keep the markets up, then we're going to continue to invest in the markets. If the market dips, that's a buying opportunity because we know they're going to push it back up. That's the Fed put. All right, now the question is that going to be the case? Will they continue to push the market back up? And some analysts say, will they be able to, even if they're willing? Do they have enough firepower? Well, we can see that per some analyst reports that have come out, we see here, using history as a guide, in order for equities to come off their recent lows. So as we know, the NASDAQ, the S&P, they're all back down to new lows. In order for them to stop declining, it will be when the Fed itself shifts. It may be that the market needs to see signs of the inflation deceleration that the U.S. economists expect in the second half of the year in order to see sustained relief. So they think that if inflation slows down, that will cause the Fed to pivot. Okay, that's one way to look at it. Possibly that's it. So are they looking at the inflation numbers? And if so, what does the inflation number have to be? Okay, that's one way to look at it. Another way to look at it is what a lot of analysts think. These B of A fund managers, they recently did a poll, and they think that it will happen at a level. So at about a 4,000 to 3,400 level. So what we have here is we have the 200 moving day average, which sits right here about 35. And so a lot of them think that when we get to about 38, and some think down to about 34, if the S&P drops to that level, that will be enough. The Fed will have to reverse course, and they'll start pumping the markets back up from there. That's another way to look at that. Of course, if we look at the NASDAQ, that's the S&P. For the NASDAQ, we're already down pretty far, down over 30%. And to get to this 200 moving day average would be about 11%. We can see here that the Goldman strategist says stocks will bottom once the Fed signals a shift. Of course, that doesn't take a rocket scientist to figure out. If the Fed shifts and starts pumping back in, then that would probably be the bottom of stocks. Of course, stocks would start going back up. Like I said, doesn't take a genius to figure that one out. And then we have here, this is what the expectations are. So these are rate cut expectations. So people expecting rates to continue being cut. And here's rate hike expectations. So what this is showing us is that most analysts are expecting rate hike to go down and not for it to go up. So we're seeing this massive divergence right here. And just for some historical precedents for you, if we look back through the S&P 500, peak to trough drawdowns of 15% since 1950. And so what we can see, the most recent one in 2020, this was March 2020, the COVID crisis, the S&P dropped about 33.9%, which was pretty extreme. We can see back here in the 2008 great financial crash, we were about almost 60%. But since 2008, we've seen a 16, a 19, and a 19. So we've only been able to stomach less than 20% in the last 12 years or so. We're at a pretty big drawdown in the 2021, but that was handled really quickly. Multiple circuit breakers were hit. They pumped it back up really quickly. So that was maybe an anomaly there. Like I said, this 2008 crash, we saw it pretty big, but all through here, 19%, all the way back to 1990, we see 33%. 2020. So that's kind of where we're at. That's why a lot of people were thinking we'd see maybe 20% before the Fed would pivot, but I don't think that's the case. All right, so what is the case then? What is it that the Fed can really do? Yeah, what can the Fed really do? Well, you hear a lot of talk about yield curve control. So you have the yield curve, and so this is the short-term interest rates, and these are the long-term interest rates. And the problem is when this flattens or when this inverts like this. And they don't want the short-term rates to be more than the long-term rates. So you hear about this yield curve control. Now, this is an obscure yield curve metric that I don't think anybody's looking at. It was just recently brought to my attention by my good friend Nick Badia, the author of Layered Money, and he's author of the Bitcoin Layer Substack. And I'm going to put a link to it down below. You might want to check it out. It's amazing research. And so there's this little known chart, and I think this is it. This is definitely something that you should be watching. So what we have here is we have the 2-year chart overlaid with the Fed funds rate. And so what we can see here is this is the 2-year in the bars going up here, and then the orange line stair-stepping is the Fed funds rate. So what we can see is the 2-year rate was going up, 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 and then what we can see here with the orange line is that the Fed was raising the Fed funds rate, staying in line with it. You can see that. What happened is right here, you can see the 2-year Treasury started coming back down. As it started coming back down, which was right here, the Fed still decided to do one more rate hike anyway. So even as the 2-year was coming down, they did one more rate hike here, which then inverted it. Now you can see the 2-year went through the orange line, and then as the 2-year, the candles, the bars kept going down, these orange bars, the Fed fund rate, the Fed was forced to reverse course and start lowering rates again. Now, this right here is back to, we looked at this chart earlier, this is in 2018. So when Jerome Powell took hold of the Fed, he got fired up. He was going to reduce rates. He was going to return things to normal. He started increasing rates until the market started crashing. And then he was forced to pivot and reverse course. Now, why is that important to look at? Well, what we can see here, again, these bars, the candles, are the 2-year Treasury rate. And we can see they shot up like crazy. Now, a lot of people said that the Fed didn't act fast enough. So now you can see the Fed is raising the Fed funds rate. One rate hike there and another rate hike there. The question is, at what point will they reverse course? Will it be when inflation settles down? Will it be when the S&P hits a certain level? Well, I think this is more telling right here. And so what we can see right here is we already printed a red candle right here. So that means that the 2-year Treasury is already reversing course, similar to how it did right here. Now, we saw that the Fed went ahead and raised one more time, even though the 2-year was rolling over. Here we have the 2-year rolling over. So could the Fed potentially raise one more time? The answer is, based off of history, most likely yes. The next thing is, how fast will these bars start coming down? And at what point will they have to start reversing course? We don't know, but this is what we want to keep an eye on. This is the level we're looking for. Most likely it's going to be somewhere in this 2.2% range. But again, these are both moving metrics, so we have to keep an eye on it. But this appears to be what forces the Fed's hands. They can continue raising rates as long as the Treasury is going up, but as soon as it's coming back down, the Fed is forced to reverse position. So that's what I'm keeping an eye on. Now, what do we do in the meantime? Because we don't know about any of this, and they may not decide to pivot. They might melt the whole market down for all we know. Maybe they want to. I don't know. But we need to have a plan either way. So the main thing we want to do is we want to protect our purchasing power. Now, you think a lot of times about trying to keep your money, but what we're really trying to do is protect our purchasing power. So what does that mean? So if I had $100,000 in the bank 2 years ago, it buys me about $65,000 worth of goods today. So even though I kept my $100,000, I didn't lose my $100,000, I still lost purchasing power. Now, it's possible that I have money into investments and it's worth $100,000 today, and let's say those investments go down to $85,000. But it's still possible that that $85,000 buys me more goods and services in the future. So we're trying to think about things in terms of purchasing power and not just in dollars, if that makes sense. So some analysts think that if we have a massive deflationary crash, gold could go down, which could be the case. In 2008, we saw gold go down along with stocks. The problem was that stocks dropped about 60% and gold dropped about 30%. So what does that mean? That means even though gold went down, my purchasing power went up. I could buy way more stocks with the gold I had than I could have before. And so that's the thing we want to think about, purchasing power. Now, a couple of things I want to think about. One, in a deflationary crash or an inflationary crash, either way, businesses. Businesses are always going to be your best return, because if inflation goes up, I can raise my prices. I can keep up with inflation. If we have deflation, then my business is generating revenue, which allows me to have more dollars to go buy things at a discounted rate. It's the one that gives me the most control. Now, when you're investing as in a business, so you're a business owner. But if you own the business, you have a little bit more control. The next thing is commodities, so real hard things. What we found out really quickly is that the central banks of the world can and will print a lot more dollars, but they can't print more gold, they can't print more wheat or oil or any of that. We can see, okay, if we see on this chart right here, this is the commodity index, USCI, and what we can see from March of 2020 here, we can see that they've basically just gone up. That's the candles right here. The orange line that we have is the S&P 500. So we can see that the USCI, the commodities dropped with the S&P 500. Everything dropped in March 2020 because of a liquidity crisis. But what we can see is that they both went up almost together, but here the S&Ps have sold off and commodities have continued to go higher. Real hard things, wheat, gold, oil, natural gas, etc. So think about things in those terms. And then sound money. So I consider gold sound money, I consider Bitcoin sound money. Why? It's money that can't be artificially increased. So here we have a gold chart. If we go back here to March of 2020, you can see that they both sold off. I'm sorry, this goes back to 2008. So in the 2008 crash, you can see gold. You can see that gold sold off a little bit, but you can see that the S&P 500 sold off way more. And then you can see right here, this is the key piece. It took about 7 months for gold to reclaim its previous all-time high, whereas it took stocks almost 7 years to reclaim its previous all-time high. Then it finally reclaimed its high and it went up a little bit, whereas gold shot through the roof. We can also see something similar here in March of 2020 when they both dropped. Gold dropped a little bit, stocks dropped a lot. And we can see that gold has been a good hedge this whole time. So we want to hold real hard assets, sound things. And then we want to be able to play some asymmetric gains, and that goes back to Bitcoin. I think it's the best asymmetric, the best risk-adjusted investment I've seen in my career. There's, could it drop down to 8,000? It's possible, sure. Could it drop down 50% from here? Sure. So you have a 0.5% downside. Could it hit $1 million? It certainly could. So I have a 0.5% downside with a 20x upside. Pretty good odds. I like those. I'll take those. But let me know what you think. What do you think are the best ways to play this inflationary or deflationary crash, whatever we have? And what do you think about Nick's new chart, this new yield curve to look at to gauge when the Fed will actually pivot? Leave me a comment. Let me know what you think down below. And make sure to join me next week for my live presentation where we're going to look deep into the macro environment. I'm going to show you the exact positions I'm buying, the names behind that, and then we'll do live Q&A. On top of that, there's a link down below if you want to join me. And that's what I got for you today, all right? To your success. I'm out.